So you're thinking of investing in rental properties, but you're stuck at that very first huge crossroads. Do you do a single-family house or a multifamily property? This is not a trivial decision. It's one that will determine the course of your entire career as an investor. From how you fund the thing, to how you manage the property, to how you build real wealth. Here in this video, we are going to break down all the things you must know and spell them out in plain English so that you can determine which direction is the best route for you. Let's get to the absolute basics. What in the world are we talking about? A single-family rental, or SFR, is what it sounds like, a house for one family. It's standing by itself on its own property, and it might be a separate house or a townhouse type thing. But the idea is there are no shared walls with other rentals. It's one house, one renter, one stream of rental income. Now, a multifamily rental, or an MFR, is a home with multiple distinct living areas under one roof. Think of a duplex, a triplex, a fourplex, or a big apartment building. Each one has its own door, kitchen, and bathroom. An MFR superpower? You have multiple income streams from one property and one loan. That simple differentiation itself flips everything. Okay, this coming statement is by far the most important thing that you will learn here today. The entire real estate world legislatively separates properties into two groups based on only one factor, the number of units. And that's the magic number 4. Properties with 1 to 4 units are referred to as residential real estate. It's a big deal because it means you can use ordinary residential loans, the kind you get on your own home, with all their great rates and terms from places like Fannie Mae and Freddie Mac. But the second you add a 5th unit into it, you become commercial real estate. This is not just a name change. It essentially flips the story around on how you buy it, how the bank will decide to lend you money, how it gets appraised, and even how it gets taxed. So pay attention. 1 to 4 units is residential. 5+ units is commercial. That one fact dictates your entire game plan. So how exactly do you take advantage of that 1 to 4 unit rule to your giant benefit? Let's talk about the ultimate cheat code for new investors, house hacking. Because a 2, 3, or 4 unit property is considered residential, you can buy it as your personal home if you occupy one of the units. What does that get you? Instead of having to make a 20 to 30% down payment on a straight investment property, you can get in on 3% to 5% down. Freddie Mac even allows financing up to 95% of these properties. 5% down? That is a game changer. You have one unit and you're covered by payments from the other units for most, if not all, of your mortgage. You're having someone else pay your rent or house payments, so you can live for pennies or nothing at all, as you build equity in a real asset. It's the best way to bypass the biggest barrier to real estate entry, the whopping down payment. Now let's dig deeper into how it works on either side of that line between 1 to 4 units. With homes, the loan is all about you. The bank is looking at your personal financial report card, your credit score, your job history, and especially your debt-to-income ratio, or DTI. They want to know whether or not you can afford to make the payment. The advantage is that they have lower interest rates. The disadvantage is that they are almost always recourse loans. That's a frightening word. That means if you fail to pay and the sale of the property doesn't cover the debt, the bank can come after your other personal assets, your savings, your stocks, even your personal home. Your entire net worth is on the line. On the corporate level, for 5+ unit properties, the game completely changes. The loan now has nothing to do with you. It has to do with the building's finances. The bank will want to see the building's net operating income, its cap rate, but most of all, its debt coverage ratio. See that the building itself brings in sufficient income to pay off the loan payments comfortably. Now, the down payments are larger, usually 25 to 30%, and the interest rates are higher. But here's the giant advantage. Commercial loans tend to be non-recourse debt. That's a giant umbrella over your personal wealth. When things turn sour, the only recourse the lender has is to take the property itself. They can't call on your personal bank account or your other assets. And while the barrier to entry is higher, Security for your own capital is much better. So to actually visualize this gap in financing, here is a side-by-side comparison. Left, for 1 to 4 units, residential classification, borrower-focused underwriting, lower down payments, but recourse debt. Right, for 5+ units, commercial classification, property income-focused underwriting, higher down payments, but that coveted non-recourse debt model. 2 completely different worlds. This brings us to still another ginormous difference: how precisely these properties are valued. For your 1 to 4 unit properties, value is figured out exactly the same way a normal house is, by seeing what similar properties in the neighborhood have sold for within recent timeframes. This is referred to as the sales comparison approach. Value relies heavily on the market's mood and what normal home buyers are willing to pay. It's neighborhood-based, but for commercial properties that are 5+ units, they toss the comps aside. Value is strictly calculated by the income capitalization method. Simply put, the value of the property is what its income determines that it's worth. This is strong because what it means is that you, as an owner, can immediately put pressure on the value of the property to increase by enhancing its income. This is referred to as forced appreciation, and it's the main method of making money in multifamily investing. The monarch of all commercial real estate measures is net operating income, or NOI. It's not your income, it's the property's income before you pay tax and mortgage. You calculate it by taking all the revenue from rent, fees, laundry, everything, and then subtracting all the operating expenses like taxes, insurance, maintenance, and management fees. NOI doesn't include your mortgage payment or big capital expenses. It only calculates how effectively the property is being managed. When you have NOI, you then use a measurement called the cap rate to determine how much value the property is worth. It's simple. Value is NOI divided by cap rate. So if you can grow your NOI either by hiking rents or lowering expenses, you directly and immediately improve the value of your asset. Lenders also employ NOI to compute the debt coverage ratio, or DCR, to ensure the property's income readily covers the loan payment. Let's talk about the everyday life of having these properties, starting with maintenance. This is where multifamily really shines due to economies of scale. Let's say you have 10 single-family houses dispersed around town. If each of them requires a new roof, you're hiring 10 individual roofers, getting 10 individual invoices, and dealing with 10 individual projects. It's a pricey per unit fee. Now imagine that you have one 10-unit apartment complex. You hire one roofer, you pay one bill, and you get a bulk discount since it's one big project. The cost per unit is significantly less. The same goes for plumbing, painting, and even professional management. Management fees for single-family homes are typically 8 to 10% of rent. But for a large apartment complex, that can shrink to 5 to 8%. Scale is reducing your expense on every individual unit. And now, one of the most feared options for any landlord: vacancy. With a single-family property, when your tenant moves out, your income drops from 100% to nothing. It's a flat cliff. You get to cover that whole mortgage yourself until you can rent it back up again with a new tenant. With a multifamily property, when one of your renters vacates your 10-unit building, you've lost only 10% of your income. The other 90% still flows in. This built-in vacancy cushion of the property is a gigantic cash flow advantage that comes with phenomenal stability. But there's a balance. SFR tenants stick around much longer, typically 3 to 4 years, because they're looking for stability, privacy, and community. Apartment renters, especially in smaller or urban units, are more apt to be temporary residents and stick around 1 to 2 years, on average. So while an SFR vacancy hurts more, it might happen less often. It's a trade-off. To really get a handle on how well you're running your property, you need to look at the operating expense ratio, or OER. That's the portion of your income consumed by operating expenses. You want a well-managed multifamily property to have an OER between 35% and 50%. When above 50%, it's a warning that something is not very efficient or the building has excessive maintenance needs. Now, a really nice, High-rent single-family home occasionally receives a super low OER, e.g. 25%, because the rental income is high relative to fixed costs. But for MFR, you've got a higher OER typically because you've got extra costs like common area maintenance, amenities, and shared utilities. The MFR owner's trick is to take aggressive action to transfer some of those variable costs, like utilities, back to the renters. And by the way, utilities are a singular headache for multifamily owners. In a single-family home, the tenant just pays all the utilities. Easy. In an apartment complex, you had shared systems and common spaces. You have 3 general methods for dealing with this. First, the all-inclusive lease. You just build the cost into rent. Easy for the tenant, but you take all the risk if they leave the AC running all day. Second, submetering. You install an individual meter in each unit. This is the fairest way, but expensive and complicated to implement. The third is the RUBS, or Ratio Utility Billing System. You split the total bill up between tenants in proportion to square footage or number of people. It's a stopgap solution for older buildings, but you have to be careful because in certain cities, it's actually illegal. It's an extra layer of complication you just don't get with a home. If you want a big portfolio quickly, scalability distinction is light years apart. Scaling with single-family properties is slow. Why? Because banks won't give you more than a dozen residential loans. To get 50 units, you'd need to buy 50 standalone homes, 50 standalone loans, and 50 standalone closing processes. It's a logistical disaster. With multifamily, you have the ability to own 50 units by buying only 5 10-unit buildings. That is merely 5 loans, 5 properties to maintain. This clustering of units under multiple commercial, non-recourse loans is the sole way of achieving institutional scale. Yes, it will require partners or syndication to put in the capital, but it is by far the fastest way to build to a large unit size. Both are diversification, but of differing kinds. With single-family, you get geographic diversification. You can have one home in a cash flow market in the Midwest and another in an appreciation market in the South. If one local economy implodes, your entire portfolio isn't ruined. With multifamily, you're diversifying in one asset. Your risk is diversified among multiple tenants within one building. You're not relying on the paycheck of one tenant. If one must move out or loses his job, the others are still paying the bills. It's unit-level diversification that gives you incredibly stable cash flow for said property. This is a significant risk factor, especially in certain markets. Multifamily properties, especially older buildings, are much more likely to be rent-controlled and subject to restrictive eviction laws themselves. In Los Angeles or Berkeley, for example, an older apartment complex might only be allowed to increase rents 3% or 4% per year, which can significantly strangle your profitability over time. Single-family homes have traditionally enjoyed a huge regulatory loophole. They're often specially exempted from so doing, especially if they're in sole ownership. But that's evolving. More and more single-family homes are being bought by giant corporations, and some states start ending those exemptions. So although SFR is still generally safer, that advantage is slowly slipping away. And now for the pet topic of everyone, paying fewer taxes. Both of these properties are able to take advantage of an enhanced method of cost segregation, although it's most helpful in multifamily. A standard house property depreciates over 27.5 years. A commercial property depreciates over a more relaxed 39 years. A cost segregation study is an engineering evaluation which reveals fragments of your building that can be depreciated much more rapidly, over 5, 7, or 15 years. Think of cabinets, appliances, landscaping, and some electrical work. By taking these huge depreciation deductions at the beginning, you can create huge paper losses that shield your rental income, and even other income, from taxation. The dollar benefit is far greater on a multi-million-dollar apartment complex than on a one-family home. This turbocharged depreciation is a boost to your cash flow. That's money you get to keep and reinvest instead of sending to the IRS. It's an interest-free government loan. and it can qualify you for the 20% qualified business income deduction by shrinking your taxable income, meaning even more savings. For the avid investor who craves size, doing these tax strategies right is no option. It's mandatory. All right, let's put it all in one place with a handy decision matrix. If you have a low capital hurdle and are just getting started, SFR or small MFR are options to consider. If you are terrified of loss of full income from vacancy, MFR is your friend. If you are willing to force appreciation on your own back, that's forced appreciation in large MFR. If you want to shield your personal wealth from business risk, you need the non-recourse debt of large MFR. And if you want an easier exit strategy, SFR has a much larger group of potential buyers. So there's the bottom line. If you are a beginner investor, your best bet is probably the 2 to 4 unit multifamily unit with the house hacking strategy. It gets you in the game with little money down and provides a great hands-on learning experience. But if you are an experienced investor with capital and a team, and you want to build a massive portfolio within a short time scale efficiently, then large multifamily with 5+ units is the only way out. The economies of scale, the non-recourse debt protection, and forced appreciation power cannot be matched by anything else for scaling. The truth is that neither method is inherently better. The best for you is whatever fits your current financial situation, your tolerance for risk, the amount of time you can commit, and your vision for your financial future. So get honest with yourself regarding where you are today. Pick the path that fits and get out there and make some money. Thanks for watching. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.